Bismillahirrahmanirrahim. Subject is advanced corporate finance, and lecture is on dividend policy. This is third lecture on dividend policy. Balance sheet learning agenda for today's lecture is balance sheet treatment of stock split, as we discussed stock split in earlier lecture. Reverse stock splits, stock repurchases, procedural aspect of dividend policy. Balance sheet treatment of stock splits. Let's suppose, as we discussed in earlier lecture, that if the same company who have 400,000 shares split the stock 2 for 1. If anybody have one stock earlier, now he would have 2 stocks. So the company would also have 2 stock instead of 1. It will double its stock, while its par value will be from $5 to $2.5, because if there was a one share having $5 par value, now the guy will have 2 share and the par value will be 2.5. So before stock splits, 2 for 1 stock split, as we have 2 million common stock, that is 400,000 share multiplied by $5 par value. Additional capital is 1 million and retained earning is 7 million. Total is 10 million equity, shareholder equity. What happened after stock split? These 400 become now 800, and this 5 par value now half, because number of outstanding share have been increased 2 for 1. Means if any person having, let's suppose, 1 share, he would have 2 share. If he would have 10 share, now he will now hold 20 shares. So stock splits is nothing than just increasing the number of share outstanding and decrease its par value. So this 800,000 multiplied by 2.5, that would become again 2 million. So nothing happened to common stock total value. Nothing happened to additional paid in capital or share premium account. Nothing happened to retained earnings. So stock splits is just increasing the outstanding share and decreasing the par value of the company. Value to investor. Effect on investor total wealth. Obviously, now let's suppose it is before stock split it was $20. Let's suppose, assume. Now it will become $20 each share. A person having, let's suppose, 1 share, now he would have 2 share. But market price, what market will say? When stock open, obviously these 20 rupees will not remain 20. Now since the share now come in the range of the middle investor, obviously trading will take place in this share, and the 20 rupees price will bit increase like this one. So it will increase the overall, it will move to 20.5, 21, 22, 23. So 21, then the share, then this will increase the investor total wealth. Effect on the investor psyche. Psyche means that is, now he was having 1 share now he having 2 share. If a guy have 40,000 share, now he would have 80,000 share, nothing else than their perception. It will impact his psyche, and even he can sell and liquidate half of his share of the company as well. Effect on cash dividend, that is important point, since dividend are issued per share, not on the price of the share. So first, let's suppose rupees 1 is declared on the share. Before stock splits, if a person have, let's suppose 10 share, he would receive 10 rupees. After stock splits, he would have 20 share, and the company when declare rupees 1 per share, now he would receive 20 rupees. So that increase the cash dividend, and it also, stock split also make a issue for the company when the company decided to declare the dividend. So number of outstanding share increases, the dividend per share to pay to the share investor will become difficult for the company to maintain its liquidity. More popular trading range, this is the third benefit, that if the company, let's suppose if we see the stock exchange, we would also see that some companies have share price 1200 Pakistani rupees per share, like POL, Nestle, Atacile companies, etc. So now this type of share is out of the normal investor who will not invest in such type of huge share. For example, if 500 lot is allowed to buy or sell, below 500, if we can't trade below 500, we will need a lot of money to buy the 500 of these companies, and we will need less amount to buy 500 share of any other company. So if stock split for, let's suppose that is 4 for 1 stock split occurred, 4 for 1, so now it will be divided by 4, and the normal price will be come to 300, and number of share will also be increased. So the supply of shares and price it's 300, so price will become to a middle range, and it will take place, the trading will take place in this share as well. So it will become in a popular trading range of normal investors. Informational contents, maybe the company implicitly give signal to the investors that they are increasing their shareholding base and have a good growth perspective, that they will maintain cash dividend to such a huge on the basis of such a huge shareholding. So these are few points that give value to investor if the stock dividend or stock splits occurred. Reverse stock splits is basically when a company have a huge number of outstanding share and have low par value, low share prices, then what they do a reverse stock splits, 1 for 4. If a guy have 40,000 share, now he would have 10,000 shares. Stock splits in which number of outstanding share decreases while par value increases. Used to move, why reverse stock splits occurred? It is used to move the stock into more popular trading range. Let's suppose if there is any company who have 5 rupees per share, it is nothing, nobody will give attention to it. So if stock splits 1 for 4 occur, now it will move to 20 rupees, 4 multiplied by 5. now it become in a popular range of normal investors. So that is one of the reason. Usually signal negative information to the market upon its announcement. Negative signal, why? It is because on the basis of empirical evidence that why the company going to have a reverse stock split, because the company share is was of no worth. That is one of the signal that may be given to the market. Now we will move to the practical examples how it will be treated in a balance sheet shareholder equity portion. A company, assume that company again have 400,000 shares at par value $5. 1-for-4 stock occurred. Means if person having 1 share, 4 share, he would have now 1 share. Reverse stock split occur. Means 4 share will be merged into 1 share. If somebody have 4, let's suppose 100,000 share, 1 lakh share, it would become to 25,000 share. So number of share in standing share decreases while the par value increases. How it will impact shareholder account? Let us see. Before stock splits, it is as it is we discussed in earlier example that 5 multiplied by 400,000 is equal to 2 million. Share additional share capital is 1 million. Additional paid in capital, that is called share premium account. Retained earnings is 7 million. So total equity is 1,000 million. After 1-for-4 stock splits is now these 400,000 will now squeeze to 100,000 shares, and share prices will increase to 20,000 multiplied by 4 is 20 divided by 4, that is equal to 100,000. Same common stock is same as it was before stock reverse. Additional paid in capital again same, is again same, but number of outstanding share decreases while par value increases. Stock repurchase. The repurchase or buyback of a stock by issuing from either in open market from stock exchanges or by self-tendered offer. They will receive offer from the shareholder, and then they will buy at a lowest price that is offered by the shareholder. For example, if they give tendered and multiple people will start them a bidding, see that we are, let's suppose first guy who gave that he have let's suppose 1 million share, or 100 1 million share at a rate of, let's suppose 20. Other guy gave that he have 2 million share and he will sell it at 19.5 per share. So if we just assume the case of these two guys, the company will buy from this second one because it gave him a lowest price. Reason for stock repurchase, there are multiple reasons as available for management stock option plan. Sometimes the company issue stock option plan for the management to give them compensation in shape of share of the companies, so in order to reduce the agency issues. Available for acquisition, sometimes the company have a strategic move to acquire any firm and they need a number of share that is with the company as well. Go private, sometime company repurchase its share from outside stockholder and become delisted from the stock exchange. Permanently retire the share, sometimes the company take the share back and expire it and vanish it, because they decrease the number of shareholding of the company. Method of stock repurchases. What are stock repurchases? How can we the company purchase fixed price self-tendered offer, an offer by firm to repurchase some its own share, typically at a set price, that we are going to purchase our price, let's suppose at $40 per share, and anyone who is willing to sell, they have to, let's suppose they have to contact the broker of the company. Dutch auction self-tendered offer, basically, as I discussed earlier, that buyer seek bid within a specified range, usually for a large block of stock or bond. After evaluating the range of the bid prices received, the buyer or seller accepts the lowest price that will allow to acquire the entire block. For example, the company say, let's suppose that we are willing to buy our share from $45 to, let's suppose, 35 per share, and number of people bid them in these in this range, and those person who bid less, their share will be buy by the company. Even number of share have been also announced that they need, let's suppose, 1 million share or 2 million share or 3 million share, and price ranges given to the shareholders. Open market purchase. Company go to open market and buy its share from secondary market through brokerage services or brokerage house. Repurchase is a part of dividend. Let's suppose company want to give a dividend to the company. Let's suppose the company have earning after taxes, means taxes, everything you have been paid, and the company have $800,000 earning. Number of outstanding share is 400,000. Earning per share means earning after taxes, this divided by this one. 800,000 divided by 400,000 means earning after taxes divided by number of share is equal to 2. This is earning per share. EPS is equal to earning available to shareholder divided by number of outstanding share. Our net income divided by outstanding share, that is called earning per share. Let's suppose current market price is per share is 31. Expected dividend per share is $1 per share. So expected dividend will be how much? Total 400,000, because the company have 400,000 share outstanding. So they will declare that much dividend. Now the company do not declare dividend in case they want to repurchase their share of that amount. What will the company do? Let's suppose expected dividend per share, that is 1, market price per share is 30, total value for the shareholder, let's suppose on one share is 31. If the dividend declare is 0, again the market price is 1. Why market price is 1? Let's 31. Let's have a calculation. There are 400,000 share that are going to be repurchased, and it is divided by this 31,000, that the company will buy 12,903 $3, approximately $13,000. So price earning ratio here be calculated. Market price, that is this one, divided by 2, which is called earning per share, EPS, that is equal to price earning ratio, that is 15. Now 800,000 divided by 3,87,097. How this figure of share come? We have 400,000 share in outstanding. How much? 400,000. And we are buying back 12,903. When we minus it, it will come this number of share we will be left with. Outstanding share will be with the people will be that much. Now we will calculate our earning per share on this new base. We have 800,000 net income divided by number of share outstanding. We have 2.07. Now if we calculate new market price, so price earning ratio is, let's suppose, PE ratio, this is divided by this is equal to, we have already, it is 15. If we have earning per share, we can calculate price is equal to 15 multiplied by earning per share, that is E. Now new earning per share is how much? 2.07 multiplied by 15, we will get that market price is $31. So if the company repurchase its share or declare a dividend, have no impact on the value of the shareholder. They would have the same value, that is $31. Share repurchases, we will discuss it. The capital gain arising from the repurchases, that is equal to 31, exactly equal to the dividend 1 that would be otherwise being paid to him. As we discussed, the result hold in the absence of taxes in transaction, that is the point. Let's suppose if there are taxes on the sale, purchase and broker, we include brokerage commission, so this $1 will not be available to the shareholder. It will be reduced by taxes, capital gain taxes and broker commission, so the value of the shareholder will not remain the same. And similarly, if we consider taxes in dividend case, then receiving $1 of dividend will not be $1, it will be reduced by the taxes that are imposed on the dividend profit. The taxable investor capital gain repurchase are favored to the dividend income, as the tax on capital gain is postponed until the actual sale of the common share. Now in this case, the repurchase is better because people can defer it tax expense by not selling the share. They would hold them these share and the capital gain will not be recognized and no tax will be paid. Stock repurchase is basically what? Stock repurchase are most relevant for the firm with large amount of excess cash that might otherwise generate a significant taxable transaction to investor. Oil companies are often considered to repurchase their stock. If they announce a dividend, this dividend, these investor will pay a huge tax on this dividend, so it is better to buy back their shares instead of paying them a dividend. So if this, they should consider the tax matter while in repurchasing the stock. First, firm must be careful not to make regularly occurring repurchases, or if we may consider the capital gain as a dividend. If the firm make it a tradition that, let's suppose, in 1 year he repurchase his share twice, and another year he do the same practice, then the FBR may change its law and say that capital gain would not be now considered as capital gain, it would be considered as dividend. So the investor will then be liable to pay taxes on these repurchases as well. What signaling effect will it give to the market? Repurchase have a positive signaling effect. For example, if stock is undervalued, management may tender for share at a premium. This signal that the share price are undervalued by the market. Actual value is bet higher, so it give a positive signals. Dutch auction self-tender have less signaling power because due to smaller tender premium. In Dutch tender, the company will buy a share on the lowest price, which do not give good signal to the market. Open market purchases modest positive signaling effect, likely due to many programs being instituted after significant share price decline. In the company share price is declining, this type of repurchases and other type of tactics are used, so the market do not see it as positive. Is it investing decisions to buy back its share? No, a stock is repurchased is held as treasury stock and does not provide expected return like other investments, so it is not investing decision. It is financing decision. Yes, it is financing decision. Why? Because it possesses capital structure or dividend policy motivation. A repurchase immediately changes debt to equity structure and high leverage, financial leverage. Means if stock is repurchased, it will increase your debt and decrease your equity. The firm become a high leverage firm. So it is a bit financing decision, and capital structure or dividend policy is a motivation of the company. There are some technical terms which we will discuss here. Let's suppose board is sitting on 1st August 2020. Already had a meeting and declared dividend. Now it will declare dividend as well as give certain time that, let's suppose, until 17th of August those people should register their name in the share register of the company, and who appear in the share register will receive a dividend. So it is called recorded date. The date set by the board of directors when dividend is declared, on which an investor must be a shareholder of the record to be entitled to upcoming dividend. Dividend have been declared here, and also announces that until 17th of August anybody should register himself in the company book of share register. If anybody was not registered till 17th of August, he will not receive any dividend. So that is recorded date. The people must record himself in the company. Sorry, that is come dividend, and 20th August is declared as recorded date. So before 20th, they have the last date to record their name in the share register company. This is recorded date. If this date is over, the person will not be obliged to receive any dividend from the company, even though he hold the share certificate. Ex-dividend date is basically the date after the record. The first date on which the stock purchase is no longer entitled to the recently declared dividend is called ex-dividend. So declaration date, the date on the board of directors announces the amount of date in the next dividend. Payment date, the payment date when corporation actually pays the declared amount of dividend. Let's suppose 31st is a date on which the company will pay a dividend. This is the date that is final, that is the up till this, the company must have, the shareholder must have to record their name in the book of account. These 2 days is to scrutinize the register book of the shares. So any people who are recorded on August 20th will receive the dividend. So often it is a practice that before 2 days of the recorded date, 2 days before the recorded, that is T-2 and T-1, 18th and 19th August are called ex-dividend. Nobody is entitled have a right to will be allowed to register their name before 2 days of the 20th August record date. So on 20th August, the board of directors will hold the record or take the record, and whoever registered in this share register company, share register of the company will receive a dividend. So before 2 days of this record date are called ex-dividend. Ex-dividend means nobody, these are the date in which who buy a share and will not be able to register their name in the register share register company. Come dividend before, which are open to everybody to register their name in order to receive the dividend. Thank you.